Wait, and I will start. Welcome to this new beginner trading class. So for those who have followed me, hope you all can learn something from here. And welcome you all here. All right, let's start now. I will introduce myself again. So I'm actually a full-time trader for past 7 years. So I do trading and investing, and I also do automated trading. So I compare different strategies in the market to make consistent profit. So I'm in charge in sharing my knowledge on trading to beginners. Today's my topic will be intrinsic and extrinsic value in option trading. So anyone is new here in option trading, or anyone had followed me since last few weeks? It's okay, then I will continue my sharing sessions now. So, today I will be talking about intrinsic and extrinsic value in option trading. So this is a summary of last few weeks slides I present, and I will just do a quick refresh here. So for last week, I shared about calls and puts options. So this is a summary of what I had shared last week. So for buyers, for calls, you actually had limited risk and unlimited profits and potential unlimited profits. Whereas for seller, you had limited you had limited risk and also unlimited profits. So this goes same as put seller and put calls buyers. So today I won't be talking much about this. This is actually the last week summary I shared. So I will continue to my next slide. Okay, today I will talk about option price, which is premium. So what makes up of premium? Actually, premium is intrinsic value and extrinsic value. Intrinsic value is part of the option that is in the money. For call, it is stock price minus strike price, whereas for the put, is strike price minus stock price. Whereas the extrinsic value will be the time value and volatility premium. So intrinsic value and extrinsic value made up of premium. When we long call or long put, we will pay the premium, right? So we must have to consider all these factors before we make a trade. So for intrinsic value, it's very easy. It's actually the stock price minus for the cost is actually stock price minus strike price. Whereas for put is strike price minus stock price. And today we'll talk more about extrinsic value, which is time value and volatility premium. So today's that actually will be Maybe there's a lot of theories, but don't worry, I will go through and then hopefully we all can learn together. So for the time value, it will decline to zero at expiration day, which is the value of the time value for the extrinsic value will become zero at expiration date. Then at the end of the expiry date, the options will be equals to the intrinsic value price. So what is intrinsic values of cost? As you can see, currently the apples is at 220. So at 210, it is actually in the money. So, so what is in the money means? Anyone knows? Okay, in the money means you are making money when you exercise the options. Let's say now currently the apple price is at 220 and then the strike price is 210. Since it is below the strike price is below the stock price, when you exercise the price, you earn the money. So that is called in the money. So for the strike price below the stock price, it is in the money. As you can see the formula below, intrinsic value of cost equals to stock price minus strike price. So if the strike price is below stock price, it is in the money. So what about 215? When the current price is at 220 and the strike price is 215, you will be in the money with $5 intrinsic value. All right, sounds easy. So at 220, it is at the money, where the intrinsic value is zero. And when it is 225, it is considered out of the money because the strike price is above the stock price. So when you exercise this cost option, you didn't have any profits. Then for 230, it's also the same out of the money. You didn't, the intrinsic values of cost is zero. All right, this is the example of in the money, at the money, and out of the money for the intrinsic value of cost. All right, I think not much difficulties. So I will move on to the next one. So let's put the example of intrinsic value of puts. So it is the same. When the put strike, now the currently the Apple price is at 220. And then as below is the Apple's put strike prices. Let us start with 210. 210 is out of the money. It's because the intrinsic value of puts equals to strike price minus stock price. The strike price have to be above the stock price. So when you exercise the options, you will be earning. The put options is when the put options you will make money when the stock price going down. So strike price must be above the stock price to be in the money. So when it is 210, the strike price is below 220. So it is out of the money. Then for 215, it's also the out of the money since it is below 220. And for 220, is at the money, which is the intrinsic value is 0. So when you exercise at this price, you didn't earn any money. For 225, since it is above, the strike price is above the stock price, you earn $5 intrinsic value. Then it is the same for 230, which is $10 intrinsic value. So this is how we know the puts and the calls option is whether it's in the money, at the money, or out of the money. For calls, the stock price, the strike price must be below the stock price. However, for puts, this is the opposite. The strike price must be above the stock price. So when you exercise the options, you make money. All right. To be in the money and to earn profits, the option must be in the money. All right. Okay. So this is intrinsic value. Remember, today I will be sharing intrinsic value and extrinsic value. And these two slides actually covers what is intrinsic value and how we know the intrinsic value is in the money, at the money, and out of the money. Maybe someone can consider to take a screenshot to do a note if you want to. Okay. Next, I will be talking about extrinsic value. And this is the Greeks. What is Greeks? Greeks actually is a value that measures all the things that affects an options premium. Remember, the thing that affect the option premium is intrinsic value and extrinsic value. And the extrinsic value consists of time value and volatility value. So the extrinsic values consist of these option Greeks, which is delta, the stock price effect on option price, gamma, the change in delta, vega, volatility, theta, the time, and rho, interest rate. This might be very confusing and maybe to understand theory behind can be quite difficult for someone, but no worries, I will try to explain it slowly and hopefully you all can take a note down when I explain it. But rest assured, you all don't really need to like fully understand it if you all can't. In the end, maybe in the coming sessions, I will share on what parameters you all should look at when you all trade certain strategy. But for now, since it is a beginner sharing sessions, so I just try to share maybe the theory and what it is for you all, and then and I also don't expect someone to like understand maybe in one go, because when we study, we maybe need take times to digest, right? It's not, and option trading actually requires like some studies, just a little bit of studies. So take it slow. I will go through one by one. If you got any questions, you all can write it down. So don't be shy. Because I'm not sure you all really understand or not. So I will keep on talking, and then I'm afraid you all maybe have some questions and didn't stop me, and maybe later on you all forget. Okay, it's okay. Then I will continue. Let's start with the time value and expiry. So in options, and from now on, what I thought about those factors is about extrinsic value. So one of the extrinsic value is the time value and expiry. In options, time value decreases exponentially as time passes. It means the option price is made of intrinsic value and extrinsic value. So now we don't see the intrinsic value, we just talk about the extrinsic value. So the time value decreases exponentially as time passes. So when a put option or a call options, when it near expiry, the value decreases a lot, especially near the expiry dates. So we have to buy the options with different times to expirations. Days to the options expiry can up from days to 3 years. And the further the expiration date, the more time value, then the higher the premium. So when you buy a options, when it is too near to the expiry, the value is very high. And then the further the expiration date, when like maybe when the further the expiration date, the more time value, the higher the premium. So when it is very near to the expiration date, the time value decreases a lot. All right, I think this is not hard to understand. So at expirations, options equals to intrinsic value when the time value equals to 0. So remember, option price equals to intrinsic value plus extrinsic value. So when the extrinsic value becomes 0, option price is just equals to intrinsic value. So time value decays the fastest during the last 1 to 2 months. So we try to sell the options 30 days before expirations. Why when we sell the options 30 days before expirations? Because it's fastest to decay. There is the buy options, right? The buyer of the options, they are afraid of the time decays. But for the sellers of the options, we all like the price decay because it will benefit us and we will earn the premium. If you all remember, in options, there is buyers and also sellers. So when the buyers wants the time value decreases slow, the other side, the seller, wants the time value decreases fast to become 0 because they want to earn the premium. Okay, maybe I think this is last few weeks basic sharing sessions from me, talk about the relationship between buyer in options and seller in options. So they are buyer and seller, one wins and one will lose. All right, just think it like that, the demand and supply. And then there is monthly option expired, and usually it is third Friday of the month. There's a few option expiration dates. All options have fixed expiration dates. There is weekly options, which expired on the Friday of every week. Monthly options expire on the third Friday of the month, and it is most liquid. Usually when we do options, we tend to find a liquid one. A liquid one means there's a lot of buyer and seller in spreads. There's enough liquidities. Liquidities means there's a lot of trading and there's a lot of buyers and sellers there. There's demand, high demand there. So we tend to trade those spread with more liquidity. And there's also quarterly options, which expire on the last day of the quarterly month. And also there is LEAPS, long-term anticipations securities. This one is the longest, expire up to 3 years in the futures. And expires on 3rd Friday of January. This is just information about there's different types of expiration date in options. And maybe you are short-term trader, mid-term trader, or long-term trader, or investor, even investors that looks for few years. So option is actually a very versatile trading tools that helps you to trade and magnify your returns in the markets. So talking about the Greek value. First of all, I will start with theta. So what is theta? Theta is the rate of decay of an option. So for example, when you look at the theta, when the value is negative 0.05, the time value of option decreases 0.05 per day. So what it means by that? It means by when today is losing values over time by 0.05 per day. Let's say today is 1, tomorrow it will goes down to 0.995. And then the day after tomorrow will be 0.99. So when we buy options, we don't want the theta to increase, right? We don't want the value to drop so fast. I think this one is by 0.5 per day, from 1 to 0.95, then to 0.9. Okay, so for theta, in buying call or put options, low theta is ideal, as we don't want the options to lose much value over time. So we want it to drop slowly, but when on the sell is another side. We don't want, we prefer the options lose value over time. Remember, when the buyer lose, the seller will win. So since low theta, the value will decrease very slow. So the option is more valuable at the end of the expiration date. And high theta, favorable selling options. All right. So just remember, for theta is the value that decrease slowly over time. So when we buy the options, we don't want the value to decrease so fast. However, for the seller, we want the value decrease fast because we can earn the premium. Okay, understand? Okay, if can't understand, it's okay. I will, because for some people, and actually for me, when I start with this, sometimes I'm not sure about the theory. But however, at the end, we will get slowly used to it. So don't worry. Next, we will talk about volatility and Vega. So why I put this together, volatility and Vega? Because volatility makes up a large part of extrinsic value. The higher the volatility, the more expensive the options. So usually when an option is very hot, like maybe there's a famous stock, like recently, a lot of people chasing, trading, like Tesla or Nvidia. The volatility, the price volatility is very high. It can up down very fast. So when many people tend to chase the stocks, the options will become more volatility, and the options will become more expensive since the extrinsic value increase, right? When many people chase, since premium is made of extrinsic and intrinsic value, right? Now we talk about the extrinsic value. When many people chase, the volatility increase, so the value will become the options will become more expensive. And also the volatility tends to increase during major news events, like the earnings of the stocks, FOMC, Fed meeting, and etc. Maybe a wars or anything like very sensitive to the markets. So for volatility, how do we measure it? We can look at one of the parameters, which is implied volatility, IV. So for value of volatility derived from the market price of an options, calculated according to the option pricing models. So this is just for your information. This is calculated by using this model, and we don't have to understand so much about it. And IV, implied volatility, shows where the marketplace views the volatility in the futures. So we don't want to buy the options when we want to buy the options when the volatility is low. It's like we want to buy a stock when it does not surge a lot. When a stock surge a lot, many people tend to chase it. Then you didn't have the good bargain. So we want to buy it when it is relative, the volatility is very relative low, which is quite stable. Because when we tend to chase the hot stock, like when the volatility is high, we tend to buy more expensive options. It doesn't mean that we can't earn by chasing the high IV stock, but the risk is higher. So for for safe for safety, we try to buy when the volatility is low. And we sell options when the volatility is high. When we become the seller of the options, we want the opposite, which is buyer of the options expire without earning, right? Like the time value is better, becomes zero, and the price is better out of the money. So for the sell options, we can earn the premium from them. So just remember, we don't want to chase when the stock is very volatile. We don't want to chase high. We don't want to buy when it's very volatile. We want it low and cheap. And then we sell when it's opposite. All right. So this is the parameters I use to find the options. When I sell options, I usually find more than 50%, because we want it to we want the options to be very volatile. And we buy the options when it's below 40%. All right. This is just a parameter we can do as a reference. So no worries. Today will be maybe a lot of theory, and no worries in futures. In futures, when when we enter into the strategy sharing sessions, I will list out what is the criteria to look at. Sometimes all these we just have to roughly remember what it means. And for those, I heard someone like had difficulty in understanding this, but take it slow and slowly digest. We have to we can't sometimes we can't like digest all these so hard, so fast. So no worries. I will keep on repeat in futures sharing sessions. So I will take it slowly one by one since this is a beginner sharing session. All right. Okay. So for implied volatility, when we buying the options, we prefer the lower IV. And then for selling options, we prefer the higher IV. I explained the reason just now. And this one is just for you all to maybe screenshots to do it as a notes. So I types out the words, elaborate it, so you all can maybe revise it to look back at what is implied volatility. Remember, we don't want to chase the stocks when it's very many people chasing and trading, like when it surges a lot. We don't want to buy at high. We prefer to buy when it is relative stable, low, and cheap. For sellers, it's always the opposite. All right. Okay. Then I finished talk about the implied volatility. Next, I will talk about Vega, this Greek's value. Remember, just now I mentioned I put volatility and Vega, implied volatility and Vegas together. So what actually is Vega? Vega measures options premium change due to 1% in move of implied volatility. So it detects the change due to 1% of IV. And it's actually volatility sensitive. And it tells you how sensitive the option price is to changes in implied volatility. A higher Vega means that the options will change more with change of IV. It means that when the higher Vega, the IV will change more. Like the IV, the volatility will change a lot. So if you think the IV will increase, the options with high Vega will be more attractive as it detects the changes of the IV. Since IV is very volatile and the Vega detects is change of 1% in implied volatility, which means it is very sensitive. Volatile is like this, right? How much it change, it depends on the Vega. Let's say the NVIDIA. Today it trade up down 5, which is very volatile. Then it suddenly become very active and the higher Vega values comes in and maybe it can trade up down 10. So this is how Vega measures the volatility. Volatility means the up and down, up and down. Maybe normally the volatility is +3, -3, and then the next day the volatility increase like +5, -5 range, and then when the Vega becomes higher, the up down becomes become bigger and bigger. So this is what the Vega's value does. So if you expect the IV to decrease, so like maybe now the NVIDIA trade up down in the up down range around 10, then when you expect it to to trade in the range up down maybe between 3, the volatility decreases. The options with high Vega value, the Vega value will decrease. So Vega actually it depends on the volatility up downs of the IV. So these two is together one. Understand? So it's about volatility sensitivity. When the sensitivity increases, the vega value increases. When the volatility of the IV, when the IV decreases, the vega value decreases. So vega helps you to understand the volatility is slowly decreasing or increasing. All right. So in buying options, high vega is good for you because it could boost the option value, right? Because extrinsic value, when the extrinsic value is increasing, your options tend to earn. So you expect it to move even the volatility to move even further, so you can earn more. So for selling options, it's always the opposite side. The lower vega is safer. You are less exposed to the change in volatility. All right. So next is the famous one in the Greek value of extrinsic value, which is how much the price of an option is expected to change when the price of underlying asset changes by 1. What it means by that? How much the price of an option is expected to change when the price of underlying asset changes by 1. So usually when you see delta, it always ranges from negative to +1. It won't have negative 1 by 1 plus 5 more than negative 1, less than negative 1 or more than +1. It always between this value. All right. So for call options, delta is always positive, 0, 0 and +1. For example, if a call option has a delta of 0.5, option price will increase by 0.5 if the stock price goes up by 1. For put option is negative and it's between negative and 0. For example, if a put option has a delta of 0.5, the option price will decrease by 0.5 if the stock price goes up by 1. So from here, we can see that the cost options is always positive, the value of the delta, because we are looking the call to goes up. So the options, the delta value is always positive from between 0 to 1. Whereas for put options, it always between 0 to negative 1. All right. So as you can see, here is the delta for calls. We look at the delta so we know whether the option price is in the money, at the money, or out of the money. ITM, ATM, or out of the money, OTM. So to be in the money, we expect the price, because the increase depends on the $1 change, right? The stock price. So it's always positive to be in the money. We want the extrinsic value to increase for us option buyers, call option buyers to earn. And then for the at the money is always 0.5, and out of the money is always negative, it always less than 0.5. The value won't be negative 1. Okay, for the delta for puts is 0 to negative 1. In the money is 0.5 to 1 delta. At the money, call is actually it's not at the money, cause it's put. I think this is just a mistake. On the money's put is more than negative 0.5 delta. Sorry. All right. So the delta is the probability that the options will be in the money at the expiration date. So we want it in the money. So delta is about the price movement. Remember when you buy the call options, the value is always between it's always positive between 0 to 1, between 0 to 1. Whereas for the call options, it's always negative because we want the price to go down with $1 change. So delta helps you to understand how much the price of an option is likely to change as the price of underlying asset changes. So we will know at which value it will in the money, out of the money, and at the money. When we buy calls or buy sell, we always want it to be in the money so that we can earn, right? We don't want it to be out of money. So we can say that delta is price sensitivity. So a high delta close to 1 is ideal when we long the call, we buy the call. Because you expect the stock to rise with response strongly to increases in the stock price. As I said, for in the money, it must be more closest to 1, right? So for sell call, since for the delta, the call will be in positive value. We want the delta between 0.1 to 0.3, especially for covered calls, where the underlying stocks are seeking extra income with limited risk. For sell call, maybe it's a little bit confusing because I didn't cover yet what is covered calls, and I just put it for your information. And don't worry if you don't understand or maybe a little bit confusing. I just put it for maybe in futures we can maybe think back what I said in this slide. So this is just for futures user. All right. So for as I said, this sharing sessions is a bit more theory. So no worries. Maybe some of you are still confusing, but in the end, we will just follow few parameters to trade. But I will say in I think upcoming maybe next few sharing sessions when I talk about the strategy. The strategy part I will list out like when you buy puts, sell puts, which value which Greek value or which extrinsic value you must look at. So we got a checklist and it's more easier for you all to follow because sometimes it's not that I say that the theory is not important, but sometimes the theory can be very hard for someone to understand to digest. All right, because it's more like technical stuff. Sometimes we just want to know, all right, delta 0. When delta is on 0 is in the money, at the money or out of the money, right? I'm sure that you don't want to understand, like go through a very technical sharing sessions, like talk about how it gets the statistics, all those stuff. Because for me, I try to look at trading to be make it simple. We don't want like so much stuff. We just want to know like which value we want to follow. Like for the IV, if you want to buy the calls, I prefer less than 40% or more than, or when I want to sell the options, I prefer more than 50%, etc. So it's apply to all of this. But we still have to go through this because it's actually part of the knowledge. And since I am sharing the beginner knowledge, so I hope you all can bear with me. and maybe somebody feels that this can be a little bit boring, but I tried to make it as simple as possible. All right, okay. Next, we go to next slide. So for puts, remember for delta is always negative. You just remember this important information. For delta, it always be negative. Either you buy puts or sell puts, you are always looking at the negative value. So for long puts, the negative value, delta close to negative 1.0 is ideal because we want the prices of the stocks falls. And then for sell put is negative 0.1 and 0.3. But for sell puts, because I didn't cover much yet, so I will just put it here for your information. We will get, you all will slowly get the ideas in the next few, I think next few sharing sessions when I discuss about the strategy. I will state it out. So no worries. If you listen until now, thanks for your support. And I hope you all have questions, or maybe you can take a screenshot down and take notes about this knowledge. All right. Next, it comes to gamma. Okay, what is gamma? Gamma actually is premium accelerations. It measures the change in delta due to $1 move in underlying stock price. It is also known as delta of delta. Gamma is highest when option is at the money. So this is how option gamma moves. So when it's at the middle, it's at the money. When it's at the money, it didn't move very fast. But when it is out of the money or in the money, near the in the money, the accelerations can be very fast. Let's say when the delta is getting near and near to be into like very deep in the money. All right, as it's not at the, it is shift from at the money to the deep in the money or out of the money, the gamma will drops. So delta can change. So for high gamma, delta can change quickly, which may lead to unexpected price movement. So for buying calls and put options, a high gamma is beneficial when you expect quick, sharp move in the stock price. So when high gamma, the delta is the rate of change, right? When it goes up in the money, it become positive. So, but for gamma, it can like suddenly accelerate very fast. It calculate the rate of the delta change. So when today the delta suddenly increase, so high gamma will also increase. So when we know high gamma, there can be a quick sharp move in the stock price. So high gamma means delta adjusts quickly to changes, helping the option gain value rapidly if the stock moves as anticipated. Like when delta in delta, when the delta changes quickly, like it's suddenly up very fast, the gamma price will increase because gamma value depends on the delta change. So when we know the gamma value suddenly surge, it's actually more favorable for those short-term trades. Because normally, if according to normal delta, it goes up like that. Then suddenly, maybe some news, some earnings before earnings, or something announcement, the delta change, and then the gamma follow, become very high. So we can look at gamma. Since in delta we just look at the in the money, out of the money, and in the money, out of the money, at the money, right? 0.0 to 1 between this. So we have to see the value of the gamma, like suddenly search the delta change. All right. So in short, delta is how fast the option price changes with the stock price. Or gamma, how quickly the delta itself changing. So when the delta ups, it can change very fast, right? It can suddenly goes up, can suddenly goes down. So it depends on the accelerations. So the gamma actually is a premium acceleration. Okay. So next, it comes to options interest. So option interest actually is very easy to understand. When something get a lot of interest from public, it means that there's meant lots of contracts that have not been settled or closed. So many people, like maybe Nvidia is very hot stocks. Then many people rush to trade the stocks. So many option contracts open or did not close, right? So you get the interest of people. So we know with a high open interest, a lot of people are actually trading this. It is, and then when a lot of people is trading this, there's enough liquid. There's a lot of, there is lot strong market participants. Many people is trading this in and out, in and out. So the volume will be there. So think it as a count of how many contracts are currently in play in the market. Okay. So why is open interest important? So based on the open interest, we know the market activities. So we want to trade stocks that has a lot of open interest. We don't want to trade the stocks that maybe you get in, you are looking, it goes out, but because it didn't catch any attention. So it can be very boring, very sideways, or the movement is not so great. So we as a trader, we want the price to be more volatile and got more volumes. So we can the price can be up down very fast. So we can earn it from either directions you are aiming for. All right. So high open interest means many traders are involved, which indicates strong interest. And there is more liquidity. There's more liquidity means there is a lot of people buying and selling. We don't want to buy a contract and then the volume is not there, so we can get the options at the bad price. With enough liquidity, you can sell the options, close the options at the good price. So higher liquidity made it easier to buy and sell of those options without affecting the price. If the options didn't have enough liquidity, maybe you buy it at $1, then the sell is 0.8, you automatically lose 20% when just by selling. But with enough liquidity, maybe you can sell it at maybe slightly below 1.0. When you buy it at 1, with the spread, the buy sell spread is better because many people buy and sell there. All right, liquidity is very important in trading, whether in stock options or any trading tools like CFD stocks, normal stocks, all needs liquidity. So for open interest increase, we also know the trend. So like Nvidia, so when it fly, so like for the few days to weeks, we know the trend is there. The Nvidia trend is there. So we roughly, you can also make a deduction that the AI trend is there. So with that, we can also gauge the market movement. maybe we can look at the other AI stocks to trade options, because since Nvidia is up, maybe we can look at another AI related stock that has not up yet, so we can seek for better trading opportunities. All right. So rising open interest means many people are interested in these stocks, and falling open interest is when it decreases. It means that many people is not interested, and we need to be careful. Like maybe last week, many people trade Nvidia these options, and then maybe a few days later, the volatility getting slowed down, the interest, those who open close contract is getting lesser and lesser. So we need to be careful uh, because there's lesser participants there. So the price movement might be not as good as during the peak when the market interest is there. All right. So we, as a trader, we don't trade those with less volatility unless you are invest or maybe trade a longer time frame in option trading. All right. So I think for open interest, it's not hard to understand. So for either buying calls and put options or selling options, we all need high interest in either way, because we want more liquidity and also strong market interest. All right, we don't want trade options with low liquidity. So all these must have high interest. So the last one will be the Greek value. Last one will be the rho. Rho actually is how much of the price of an options will change if interest rate changes. So actually this is just minor affecting to the option price. So I will just go through very fast. So options are a bit like the piggy bank. When you buy, if the interest rates goes up, it becomes more valuable. When the rates go down, it becomes less valuable, like getting less interest. You just think like when you buy options, you will get the interest, and it becomes more valuable when the rate goes up. And then if the rates go down, you get less interest. So it is less valuable, but it doesn't affect much. So just a recap. Just now we are talking about theta. Theta is about how much the price of an option decreases and get closer to its expiration date, time decay. You can think theta equals to time decay. When it closer, theta is smaller. When we long the call options, we want the theta to be lower, because we don't want the price like decay a lot, decrease faster, right? So how much value of your option loses over time if everything else stays the same. This is important for understanding the time risk involved. So we also talk about the Vega. Remember, the Vega is measured about the IV, implied volatility. It measures how much the price of an option is expected to change with 1% change in implied volatility. How it helps you? It helps you understand how sensitive your option price is to changes in market expectations of volatility. All right, like just now I said, the volatility can be maybe today up down 3 in the +3 to -3 range. And then when the volatility increase, IV increase, it can become +7 to -7 or +10 to -10 range, up and down, up and down, up and down. And then when the Vega become higher, means the volatility is higher, higher, and higher. So when we trade we buy options, we want the Vega to become higher, because We want it to move up, down a lot. When we trade, we don't want to trade a stock like maybe up, down, minimum, right? We want to trade a stock that have the movement so we can earn, earn the bigger value. So for delta, it measures how much the price of an option is expected to change when the underlying asset's price changes by 1. So it helps you how closely your option price is tied to the stock price. You just remember the delta the value is positive, and we are looking it to determine whether the stocks in the money, out of the money, or at the money. So delta for the call option, either you buy or sell, it must be positive, 0.0 to between 0 to 1. So for the in the money, at the money is always 0.5. So for out of the money is less 0 to 0.5. For in the money is 0.5 to 1. It's the same for the when you're buying puts, but however the puts is in negative value, right? So for gamma, it measures how much delta will change when the underlying asset's price changes by 1. Remember, when the delta is going up, and then it can be suddenly goes out, goes down, right? So this is gamma. The acceleration, it can suddenly accelerate. It tells you how stable or volatile your delta is and helping you gauge risk. So maybe a lot of information today. So I hope I have ended all the explanations about the Greek value. So I maybe you all can take a screenshot when we take a screenshot about the summary. All right. So maybe you all just focus on the buying cost and buying puts. For the selling cost and selling puts, it can be quite confusing. But I just put it here for maybe better future reference. Okay, so this is today's I finished my sharing sessions about intrinsic value and extrinsic value. Remember, option price, which is premium, is made out of intrinsic and extrinsic value. And the extrinsic value includes the time volatility and the Greek, all these Greek value. Delta, gamma, theta, vega, rho. Rho is actually is minor. It didn't like really affect the price a lot. And then other than Greek values, open interest also one of the reasons that affects the option price, and also implied volatility. All right. So any questions today? So today is a lot of theory, and I hope you all did learn something. You all can just maybe look back at the replay or considers to add me. Or for those who doesn't have use smart app, maybe you can consider to use my referral code. For the left side is Hong Kong app. For the right side is Singapore app. And the mid one is WeCom. Maybe you all can consider use WeChat to add me. I have also has a Telegram group, which in the next slide, I will just put this 1 minute, and then I will give you take a look on my on my Telegram group. But so far, there's no people to join me yet, and I just aim to share more knowledge for beginners. All right. So this is my Telegram group, and thanks for your for listening and stay until the end. So don't worry if this today's sharing is like a bit more on theory, but for the upcoming strategy lessons, I will share with you all what we need to look at. So, so actually it's not that complicated. So don't worry, but you all can, this is just a knowledge. So we need to go through the basics one, right? We need to learn how to walk before we learn how to run. So the basic stuff we need to cover. So you all have an idea on what actually it is. All right. So this is the disclaimer. And thanks you all for joining me today. I hope to see you all in the coming sessions. All right, I will be sharing um, how to become a profitable traders for beginners in the upcoming Thursday night. So feel free to join me. And remember to follow me and maybe consider to add my groups. All right. Okay, have a nice day. Bye.